Alright guys, so this economic war is getting from bad to worse. A new oil war between OPEC and the US might be coming. Things are going to get really ugly. Then you have China being targeted once again. Now first it was banning AI chips. Then we have the TikTok disaster, but it has now reached new levels of insanity. Joe Biden is now targeting the Chinese shipping industry. And we must talk about this because battle lines are being drawn. Russian oil is under fire and China is becoming the big boogeyman today. But let's do an update on the Russian refineries first because the attacks aren't stopping. Ukraine just hit the third refinery on Russian soil using drone attacks, and this caused a fire and disrupted operations in yet another major refinery. Now, Putin believes that this is Ukraine trying to interfere with the elections, or maybe Zelensky is trying to get a better negotiating position at the end of the day. But to me, I think it's far more simple. It looks like strikes of desperation to project strength. But let's analyze the attacks. The Ryazan refinery has a capacity of 17 million tons a year. It is once again deep into Russian territory, just 120 miles away from Moscow. Together with the previous North Sea refinery, at least 10% of Russia's total refining volumes are affected. But as we said before, this is a crazy strategy to try to take down Russia's revenues. It won't collapse the Russian economy, but it will disrupt the delicate balance of supply and demand in the oil markets. While it's true that Russia can't refine as much gasoline or diesel, their revenues might actually head up. Looking at the price of Brent crude, it has shot up from $82 to beyond 85 within a matter of days. That big spike up isn't benefiting Ukraine but Putin because Russia's main income is from selling crude oil. The strikes are backfiring. It's actually pushing Russian export revenues higher. It is the exact opposite of destroying the Russian war machine financially. And another big winner is China. It helps Beijing to earn more by refining Russian crude and then selling the products to Europe. But this tactic is something Ukraine is just going to continue. It's great optics, right? The West is reporting those as victories, and is winning the PR war is a fantastic media strategy. Ukraine wants to disrupt Russian exports to the world. They are fighting everything that finances Russia's economy and the war. And this is the new front against Russia. The target is now Russian infrastructure. But something tells me this isn't going to work. So far, two refineries has been damaged. Those are the ones in red. But pay attention to the grey circles. These are the refineries that are still fully operational. A ton of them are within range of Ukraine's attacks. We can expect more attacks on Russian infrastructure to frustrate Putin further. But taking down the entire Russian economy is just not possible. According to the IEA, Russian revenues from oil exports are not collapsing. In fact, in February, Russia put in $15.7 billion. That's higher than the average of the past 12 months. The price caps didn't work, and if crude keeps going up as a result of the refinery attacks, we can expect Russian profits to rise as well. This won't work out as Ukraine expects. But let's talk about Putin's warning to OPEC. He just told Saudi Arabia to be wary of a big oil competitor benefiting from the oil cuts. During an interview with State TV, Putin made a big statement about the production cuts. On the surface, he supported the OPEC Plus cuts, but deep down, he knows there's a problem building. Yet the output is dropping while it grows in other countries such as the US. As a consequence, we may lose markets. And that's the risk of production cuts that we talked about before. Because oil demand is inelastic, decreasing production can work to ramp up the price. If production goes down by 2% but prices fly up by 5%, this is a win for OPEC Plus. Russia and Saudi Arabia makes more money. But there is another silent winner as well, and that is the United States. Putin realizes that America has been pumping out more and more oil. The production cuts from OPEC are helping the US earn more money as well. Since 2010, US crude production has been going steadily up. It went from 5.5 million barrels to over 12 million last year. And in 2024, the EIA projects this to hit well above 13 million barrels a day. Higher oil prices allowed the US to extract oil from shale. It made exploration and production feasible, and this in turn affects the supply and demand equation. It is a counter to OPEC's oil cuts, and this is what Putin was warning about on Friday. While cuts helps to boost oil revenues, if the US keeps pumping more, it is counterproductive, and they'll keep pumping as much as they can because the price is going higher. OPEC could lose market share while America makes more money. So there is a physical limit to how much oil OPEC can cut. We are heading towards a turning point. In 2023, the US was the biggest producer of oil in the world. They produced nearly 13 million barrels a day. Russia is at number 2 at 10 million, while the Saudis at third place with 9.7 million. The more that OPEC cuts, the US will grab a larger slice of the market. Higher oil prices encourages them to increase production even more. If we look at the biggest growth in oil production, the Americas will be contributing the most. Volumes in the US, Guyana, Canada, and Brazil will be heading up. In 2024 and 2025, US production could increase by almost 1.2 million barrels. If OPEC keeps cutting production, they will lose more ground and volume to the US. Russia still needs revenue to fund the war, while Saudi Arabia still needs money for their investments. But going forward, we could be in a very dangerous economic war for oil once again. Now, 10 years back, Saudi Arabia declared a price war on US shale oil, and the plan was simple: increase production to the point US companies lose a ton of market, flood the entire market with a ton of oil. The cost of production in the US is much higher than Saudi Arabia or Russia, and by flooding the market with volume, you can effectively halt US production. Even if prices rise higher after that, restarting the fields will take a long time. OPEC's price war saw an increase in oil bankruptcies. It surged by almost 400%. Dozens of US producers went under with 55,000 jobs lost. And this also collapsed the price of oil down to $26 a barrel in 2016. That's a big crash from the peak of $90. And this could very well happen again if OPEC decides to defend their market share. At the moment, it is not possible because of the war and Saudi Arabia's need for money. But if push comes to shove, another price war isn't impossible. It worked before and OPEC could always play that card once again. But let's shift focus to the battle between the US and China. Things there are getting progressively worse. Beijing is now the big boogeyman, and it is without a doubt that Biden is trying to suppress them. First was Raimondo's commitment to sanction Chinese tech. She mentioned how the US will do whatever it takes. That is bad enough, the sanctions on AI chips won't end. Let's not forget the crazy TikTok saga. The US just passed a bill to force the sale of TikTok to an American company or face a total ban. And the basis is, of course, once again, national security. I have no idea if TikTok will fold their hand, but if they do, sell it off to the US, it will be quite humiliating. It would set a precedent where any Chinese technology could be divested on the grounds of national security. And this would just decouple the US and Chinese markets even further. Even Trump and Elon Musk are against this. Now just imagine if Beijing forced Tesla to sell off its gigafactory. It would be unthinkable in the US. But a new battle in supply chains is about to start. The US isn't done with the war on Chinese tech just yet. They are going after industries. They are now targeting Chinese shipping as well. President Biden is now targeting Chinese shipbuilders because they are getting subsidies. And this is very ironic considering the US government also gives a ton of subsidies to their own industries. China is the world's leader in shipbuilding, and that is making the US very nervous. Once again, we are seeing this economic war escalate and break new grounds every single day. Now, and this is bigger than TikTok. It will affect global supply chains. Trying to disrupt Chinese shipping could open Pandora's box once again. This will cause inflation in the US and the world to surge higher. And let's understand this hysteria. China today dominates global shipbuilding. Over the last 10 years, China has been the biggest builder of merchant ships. All those container ships bringing your stuff, well, one of two are Chinese-made vessels. And just last year, the market share has risen above 50%. They built more ships than South Korea, Japan, and Europe combined. If you want to transport stuff around the world, you still need China, and that is frustrating the US out. And this brings us to a dangerous inflection point. What will the US do to counter China's dominance? Because either option is dangerous. It will either be a subsidy battle or trade war. According to the Steelworkers Union, we will soon be dependent on China not only for the products their vessels bring in, but also for the ships themselves. And it's quite obvious what this is. The union wants Biden to give the steel and shipping industries more subsidies to compete. But will it be effective? Will it really allow them to build better ships at a more competitive price? Or will it just result in misallocations and higher inflation? That is the big question here. But the other option, the trade war, is even more risky. Biden could always slap more tariffs on ships built by China coming to the US, and this will discourage the world from buying ships from China. Countries like France still buy vessels from Beijing. French shipping giant CMA bought 16 container ships worth $3 billion last year from China. Even Taiwan buys ships there as well. And this is the market share that Biden is eyeing. US shipyards are stagnating today. And if the plan is to bring manufacturing back to America, it will have to come at the expense of the Chinese. So we might be on the brink of a new trade war. Things could get really ugly in the months and the years ahead. It's no longer just technology, guys. Global shipping is now at risk. And speaking of danger, let's talk a bit about the Eurobond situation. And by now, we know Europe's big push towards a war economy. And the idea is simple, right? The Russians are winning on the field. We have Donald Trump winning in the elections, and funding to Ukraine is drying up. So there's a sense of panic in the air. Europe needs to defend themselves. The Russian threat spurs EU's lending arm to look at funding defense spending. And once again, the Russian threat is a catalyst for the idea of issuing more bonds. And this time they want the European Investment Bank, the EIB, to invest in the military industrial complex. And to do this, they are going to redefine what dual use means so that includes ammunition and weapons as well. Now, this is a significant move because the EIB has a ton of money. They have issued over €250 billion worth of bonds to the market. The EU wants access to the financing power of the investment bank. With the EIB selling bonds for them, they will be able to fund their war and defense spending. The EU wants to do this without affecting their national economies. They want their cake and they want to eat it too. And here's why. The EIB has a AAA credit rating from Moody's and Fitch. That means they can borrow money at lower interest rates versus many other countries in the EU. Countries like Italy and Spain can't borrow at cheap rates anymore. Yields are well above 3% there. And more importantly, it doesn't add an immediate burden to each country's balance sheet. It's a strategy to get the money you want now and postpone the consequences to the future. The beauty of the EU bonds is that the debt doesn't appear in your national statistics, so in principle, you can get funding for whatever you think you need without having to incur the penalty. And that sounds great, but as we all know, there's no such thing as a free lunch. Sure, the Eurozone as a whole can issue more Euro bonds, but it is still borrowing money. That is debt that has to be repaid with interest. The boomerang will come back eventually. The problem with funding Europe's defense project is getting a return. Now, it's fine if you invest $1 billion and you get 5 to 10% return a year, and that will easily cover the interest payments. But what if the EU defense project fails? This is the big concern that EIB has, and they have voiced this out. And here's the big fear. They're afraid that defense financing can hurt their top credit rating without addressing the problem. And that problem is long-term contracts. If they build up Europe's defense industry, who will be buying those weapons long-term other than Europe itself? The military defense complex in the US is just too big and dominant. It is crazy to try to fight with them. Plus, manufacturing costs in Europe is just too high. How are they going to steal customers from the US when their weapons cost just so much more? Europe can't compete with the Americans when it comes to the MIC. Defense spending sounds really nice, but if the EIB finances this and it turns out to be a mistake, which probably it will be, the debt still needs to be repaid. The burden could fall onto the countries, the individual nations in the EU, and we all know what that means. It will ultimately fall on the taxpayer. Taxes will have to go up to pay back the loan, and that's how risky it is for Europe's defense project. But let's end with China. This is where the main economic front will be. If you think sanctions on Russia was bad, things between the US and China, they are going to get worse. The pivot from real estate to high-tech manufacturing is freaking the West out. More hammers are going to be dropped on Beijing. The madness isn't over. A leading Chinese economist is warning that the protectionist wave against Chinese goods isn't ending. As Xi Jinping pushes towards a stronger industry, the West will be fighting back. If we look at the expansion of bank loans, it's very obvious where the Chinese economy is moving towards, a complete shift towards industry and manufacturing. In Q3 last year, loans to manufacturers hit nearly $700 billion. That's an insane amount of money. Conversely, real estate loans hit negative $14 billion. This shift towards industry is a very extreme one, and it should be no surprise why there's a backlash from the West. Any rise in exports from China will come at the expense of the US and Europe. So this economic war on China isn't going to end. It's going to get nastier. It's going to go beyond technology and affect the biggest sectors around. It's going to destroy global trade as we all know it. But let me know what you think. Are the attacks on the Russian refineries that serious? And how bad will this economic war evolve to? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.